So when is it safe to get back into those social media sectors? Okay, so first off, read this disclaimer carefully and do your good deed of today by liking and subscribing. So the thing is that when we go here to communication under the sectors and we look at social media, then we do see that there's been a total massacre. So minus 48% here from the 52-week highs. So this is one of the reasons why it can be beneficial to be a contrarian, because it was during these peak euphoric bullish phases that it made a lot of sense to turn bearish, and this ETF has a strong history of going up fiercely and also down very fiercely. What is pretty spectacular about the recent sell-off is that it's so it comes from already a very oversold level. So when we go here and look at these indicators, RSI set a record. We have never been this oversold, and we have never been this bearish on the PPOs, and they measure the distance between price and various moving averages. So there is extreme pessimism in the social media ETF. The problem is that we don't have any signs yet that the bulls are back into action. So the current setup is that the bears are ferocious, they are not taking any prisoners at all, but we don't see bulls yet. On the other hand, the problem is that this is not an ideal place to go short. Yeah, this is very oversold, and from low levels you can get very big moves up. So, I mean, the times where you really can get destroyed as a short seller, that's when you are shorting something that is very, very oversold. Here on the daily data points, we have a very similar message. We have, across multiple indicators here, records in terms of the distance from the 200-day and 100-day moving average. We have records. We have been more oversold, I guess, in terms of the 20-day and the 50-day moving average. And also the RSI has been somewhat lower in the past. So I think the key thing here in terms of the line in the sand is that we are definitively very much oversold. So definitively oversold, just say 360 because it's just all over the place. So this technical setup, even though the bears are still very much in control, this is a situation that is dangerous for many types of bears. So short, medium, long term. Okay, the short-term bear still sort of is in control, but when we look here at the more medium and long-term trend, the current readings are dangerous. They just are. So I do think I will give the technicals here slightly here to the bulls, to give them a bit of the benefit of the doubt. But let's be perfectly clear, we do not have any sign yet that the bulls are regaining control or have any kind of confidence. It is more that the current setup is more dangerous for new short sellers than for new bulls. When we look here at the seasonality here to the right, so we are currently in a period that has a tendency to be a bit weaker here heading towards later March, but then we see that the bulls tend to come back into action in a very big way. So looking at the average over the last 5 and 7 years, the seasonality is definitively constructive. Looking here to the left, we do see that March is one of the weakest months, but April, May, and June are strong. Over the last 10 years, March is weak, April, May, June strong, and then looking at all the data we have here over the last 12 years, yes, March is weak. And we have definitively seen weakness so far in the March. As you can see here, looking at the seasonality, there's a tendency actually here for March to be a bit, to have some gain here early into March and then give it back. But when you look at the current March, it's just been straight down. So as such, you could argue that we have already seen the weakness we tend to see in the March, but we have not seen the usual strength we have in early March. Given that April, May, and June are strong months, that increases the probability that short sellers will close out some of their positions. To close out their positions, they have to buy, which could help form a low. I think the seasonality here is rather constructive, so I will actually give the bulls here, what will I give them? I think I will give them a 4. I could give them a bit more, but the problem is that, you know, the setup is so overwhelmingly bearish across, you know, looking at, you know, the charts have shown us that they don't care about seasonality. But the fact is that the seasonality for the coming months is strong, and we usually, as we saw, tend to see some strength even in March. So here I am comparing the social media ETF against the Vanguard Communication Services ETF, which is a bit broader. When we look here at performance, year to date, you know, it's the SOCL is now it's down minus 30%, huge. Beta is actually a bit lower than VOX. PE ratio is high, but it's important to just be aware that there are different PEs for different types of business models. Yeah, there's no dividend. Yeah. Okay. So when we look here at, you know, the holdings, so we have Tencent, Facebook, well, Meta and Alphabet, Snapchat, Twitter, Singa, Baidu. So yeah, we do have quite a bit of a mix here. Do we have any of the Russian social media? Yes, here you can see that Yandex is actually still part of this. So that is, I mean, you are getting, you know, broad exposure here to social media. So it's not like you are all in on the American companies. I mean, this is relatively nicely diversified. So that is good. Do they have Rumble? Because that is one of the up and coming competitors. No, I don't see Rumble, but yeah, that's one of those that could be added possibly later, because that's one of those that try to cater to those who have been kicked off, you know, Facebook and yeah, Twitter and so on. Okay, and you also of course have Donald Trump's social media platform. That one is going live at the moment, and one would assume that that one will be included into this ETF as well. Okay, so here you can see, you know, a bunch of large caps because the business models in social media is very much winner take all. So those who become big, they become very big. Yeah, when we look here at regional breakdown, yeah, very tilted towards North and yeah, basically America. But you know, there is some significant exposure here to Asia Pacific as well. Yeah, so here you can see the top countries. So China is actually in second place, pretty close after America. So in terms here of the fundamentals, what I will punish this one a bit for is that it doesn't have the, like, the up and coming social media competitors. So I wish that this one was a bit broader. But it is, you know, relatively diversified. You get exposure to different places on the planet. The risk I do see, however, is that there's been some talk about more sanctions. One of the sanctions has been that Chinese companies that work with Russian companies could potentially be sanctioned. So basically, if those kinds of sanctions also happen, then that would be really, really bad for this ETF. So that's definitively a risk here that you just have to be aware of. So I will give the fundamentals here, I think I will give them a -1. I do feel a little bit bearish here, but I do think that many of these stocks, they are at valuations they haven't seen in a long time. So they have definitively been repriced. Here we have correlations between the social media ETF and the S&P 500 at 79%, 82% with the technology ETF, XLK, 92% with the communication services ETF, WOX, and then -21% with the 10-year yield. A lot of people have made a huge deal about how powerful the 10-year yield is vis-a-vis tech companies, but the correlation here is, it is negative, but it's not like -90% or anything like that, which would mean that they move opposite each other. Here, looking at short-term correlations. So let's actually zoom a bit out here. So you have 20% with the S&P 500, 7% with technology, 98% with communication services. Here you have minus 80% with the 10-year yield. But as you can see here you can see the statistical correlation over time, and you see that we are now at a very low end of that range. The previous time we had a deeply negative correlation with the social media, between the social media ETF and the 10-year yield was here, and that formed a temporary low. If you look at this negative correlation here, it was a bit of a rocky period, but this was also close to forming a low here for the social media ETF. So that's interesting, very much so. Okay, so let's look here at the VOX. Because that is the one that will have, well, most likely to have an effect on the social media ETF. We see something similar here in terms of the charts. This is definitively one that's seen a massive sell-off. Previous time we had this extreme RSI was here, and that was literally during the lockdown. So we currently have lockdown level RSI on the VOX ETF. The previous time, it was an amazing time to buy it. The only but I see here in terms of oversold readings would, let's go back here. Okay. So during this sell-off here, during the global financial crisis, bear in mind, this was the bottom of that major super bear market. During that mega no mercy bear, we did actually get even more oversold than what we are now. So if the market thinks that the current conditions are as bad as it was during the global financial crisis, then one could see this one set even lower levels on these oversold indicators. But that would be very, very pessimistic. Here we are looking at the social media ETF against the VOX, the communication services ETF from Vanguard. We do see that the social media ETF has massively underperformed VOX lately, and we do have a breakdown here in this relationship. That is not good. It shows us, extreme, record. We haven't underperformed like this since, I mean, it's just really bad. But, that does not mean that it's a good time to go short either. That's the issue with these protracted sell-offs. Similar to how when you have a protracted outperformance like here, that is when it is very dangerous. It becomes increasingly dangerous to put on bullish positions. Looking here at the daily data points and peeking at the seasonality. So from a seasonality perspective, we usually tend to see a little bit more underperformance from social media, but then it has a tendency to outperform rather reliably towards mid-June. So that's interesting. Now let's look at the relationship between VOX and the S&P 500. So this one has been in a very substantial downtrend, massive underperformance, and it has now set a record. It's never been this bad in this relationship. Now let's go here to the daily data points and look at seasonality. So looking at the last 10 years here in red, we do tend to see underperformance here towards May. Here you have in blue the last 7 years. I mean, the seasonality is not really constructive. So in terms of the data we have here, the issue for the social media ETF is that VOX is also just not looking good. The big but with VOX is that we did see that the previous time we had this RSI reading marked the low, the best time to buy VOX ever. It was an amazing time to buy. That's a bit interesting. We also saw in the relationship with the 10-year yield that we are currently at an extremely negative correlation. Previous times we were this negative, it formed lows on the social media ETF. It was actually a contrarian signal. So in terms of relative performance here, I will give this one very mildly to the bulls. I will give the bulls a 1. But that's a contrarian one. They haven't done much to deserve much bullish points yet, but it's just that historically speaking, the current setup is also very dangerous if you are a bear. It just is. So to sum up the points here, we do end up with a 1.5. So the data is more favorable to bullish positions than bearish. But to be perfectly clear, this is more talking about a potential bounce. It could also be a longer term low. It is just that I would, if someone awarded me like 100 grand and I had to be long or short this ETF for the coming 6 months, I would be more concerned about being short it for 6 months. It's more like that. So that's something to always think about when considering any kind of security. Would you be more comfortable, sleep more comfortably by being long or short? Because it is quite binary in that sense. And yeah, I would feel more comfortable being long in this ETF at these levels. But to be perfectly clear, the bears are still in control.